So hello friends, so welcome back to my channel. So let us continue. In the last video I left the half of the chapter, that is revision notes I was doing. Revision in that chapter, that is national income accounting. This chapter uh, I was doing revision for exam, so half of it was over, so let us continue from there. So yes, here it was finished, right? So one minute, here's aggregations of national income I was explaining. Means I was saying what are the important things here in this. So fourth one I was doing, right? So fourth one, that is in aggregation. In this fourth one is net domestic product at factor cost, NDPFC, that is also we can call it as domestic income. So it is the factor income received by owners of the factors of producing for providing factor services in domestic territory throughout a fiscal year. It is the total worth of all finished goods and services excluding depreciation and net indirect tax. So thus it is equivalent to the sum of all factor income created in the country's domestic area. So factor income formula is NDPFC is equal to gross domestic product, GDP MP, and depreciation and indirect tax plus subsidiary, or we can also write it as NDPFC is equal to compensation of employees plus rent plus interest plus profit. This form also we can write. Next is net national product at factor cost, or national income, NNPFC, or national income also you can say. So it is a aggregated of all factor earned by ordinary people of a country in the form of wages. It may be during an accounting year. Rent, interest and profit are calculated for the. So it is the sum of all the factor income earned by an ordinary citizen. How much he has earned. National throughout this accounting year, how much he has earned, including employees pay, rent, interest, profit, etc. The formula will be like NNPFC is equal to NDPFC plus factor income earned by normal residents from abroad, N factor payment made to abroad, O or NNPFC is equal to NDPFC plus NFIA is equal to national income. So this is the formula it will be. Sixth one, it is gross national product at market price, GNPMP. So it is the market value of all finished goods and services generated by a country normal citizens throughout their accounting year. So MNPFC is equal to GDP MP plus NFIA, or you can write this formula as GNPMP is equal to NNP, that is here fifth one here, right? NNP plus depreciation plus NID. So this formula is to find gross national product at market price. Next is net national product at market price, NNPMP. So it is the sum of the factor incomes earned by normal citizen of a country throughout an accounting year, including it may be net indirect taxes. NNPMP is equal to NNPFC plus indirect tax minus subsidies, or you can also write it as NNPMP is equal to NDPMP plus net factory income from abroad. Okay, so this is the formula for net national product at market price. Next is eighth one, that is gross national product at factor cost, GNPFC. So it is the sum of the country's normal people's factor earning over the course of an accounting year plus depreciation, that is GNPFC is equal to NNPFC plus depreciation, or GNPFC is equal to GDPFC plus NFIA. This is the formula for gross national product at factor cost, GNPFC. Next is national income at current price, type 1. So here, when the products and services generated by ordinary inhabitant within and outside of a country in a year are evaluated at the current year's value, current prices, this is referred as a national income at current price. It is also referred as it is also known as nominal national income. Y is equal to Q into P. Here it is a formula. Here Y is the national income at current price, and Q is the quantity of goods and services produced in a accounting year, and P is the prices of goods and services during the current accounting year. Okay, so this is the formula. Next, 10th one, it is national income at constant prices. National income at constant prices. Here, national income at constant prices refer to the worth of products and services produced by ordinary inhabitant within and outside of a country in a given year at a constant price. The base year price, it will be it is referred as the y to the power comma, that is national income at a constant price. Q is the quantity of goods and services produced during an accounting year. P is the price of goods and services prevailing during the accounting year. Next is GVA at market prices. GVA, it is the production and product taxes are included in GVA at market prices, whereas production and product subsidies are excluded. So therefore GVA is equal to GVA at market price is equal to GDP at market price. How much GDP of market price? 12th one is GVA at basic price. GVA at basic price, it is the it will be the exclude production subsidies available on the commodities and incorporate production taxes. GVA at basic prices is equal to GVA FP minus net production taxes. This is a formula. Next is GVA at factor cost. GVA at factor cost does not contain any of the taxes or subsidies, so therefore it will be GVA of factor cost is equal to GVA at basic price minus net production taxes. This is the formula. It will be. Next is so these are the 13 aggregation of market of national income. So in these 13, anyone they may ask, or they may ask for any marks, like 1 marks they may ask for anything, or 2 marks to write explain and write the formula, or they may ask for 5 marks by giving the names, right, explain and write the formula for these aggregations of national income, they may ask. Okay, next let us come to for next topics revision, like GDP and welfare. GDP, it is the measurement of economic value of all the goods and services produced within a specific time period, which is typically annually or quarterly. So GDP is also an important question. It may be asked for 1 marks. And GDP are classified into 2 types, that is real GDP and nominal GDP. In real GDP, real gross domestic product is an inflation adjusted estimated of all of the value of all goods and services generated by an economic each year. It is also known as the constant price or inflation corrected or GDP at constant prices. Okay, next is so for real GDP formula, you have to use real GDP is equal to nominal GDP by deflator. This formula you will use if you use nominal GDP by deflator, you will get the how much is the real GDP. Next, nominal GDP, it is the product and services produced by all producing units in a country's domestic territory during an accounting year and valued at the current year prices, or current prices are referred to as nominal GDP or GDP at the current prices. So for nominal GDP formula, nominal GDP is equal to real GDP, how much is there, into GDP deflator. So conversion of nominal GDP into real GDP is equal to nominal GDP by price index, how much is that here, into 100%. If you do, you will get a real GDP percentage. Now GDP deflator, here you can see formula, GDP deflator was there. No, real GDP, GDP, real GDP for first type of GDP, into what is GDP deflator. That is GDP deflator, it is the nominal to the real GDP ratio, is also well known as price index. This is known as the GDP deflator. Thus GDP denotes nominal GDP and GDP denotes real GDP. Then see, GDP deflator, how to find this, is equal to GDP, how much that here, by GDP nominal GDP into percentage, if you want, into GDP 100% you can do. Next is welfare. So here welfare, people, material well-being is referred to as welfare. It is determined by a variety of economic elements such as national income, consumption level, product quality, etc., as well as non-economic factors such as environmental, pollution, law and order, so on. Economic welfare refers to the welfare that is dependent on economic variety. And social welfare is defined as the sum of the economy and non-economic well-being. Next, there are some limitations. This also they may ask for 2 to 3 marks. What are the limitations of per capita real GDP as an indicator of economic welfare? So the exclusion of non-market transaction externalities are not included in GDP, but an impact of well-being. GDP does not accurately reflect the quality of economic development. Not all products make contribution to economic welfare. Some products may have a detrimental impact. Inflation may create the impression of a decline. So these are the limitations of per capita real GDP. Next is method of calculating national income is product method or value added method. First method, in this product method, it refers to a firm production activities that add values to raw material. Alternative values added is defined as an entrepreneur contribution to the present flow of product and services. As a result, value added of a firm is equal to value of output minus value of intermediate goods used by the firm. This is the formula for product method or value added method. Anything they may ask for 1 or 2 marks. Next is value of output. Value of output is there. In that value of output, an enterprise output is the commodities and services it produced during a accounting year. The market worth of all goods and services generated by a firm throughout an accounting year is referred to as the value of output. Value of output is equal to quantity of output into price, or value of output is equal to sales plus delta stock. Next, this is change in stock, sales plus delta stock or change in stock, you can say. It is calculated as the change in stock is equal to closing stock minus opening stock. What is the closing stock of that year and minus opening stock? If you do, you will get the change in stock. Next is intermediate consumption is there. In this intermediate consumption, it is referred to the value of non-factor inputs or raw material which is used in the process of production is known as the intermediate consumption. Next, second type is expenditure method. First was the product method or value added method. Second one is the expenditure method. In this expenditure method, it is believed that the value of the domestic income is equal to sum of the expenditure on the purchase of final product and services produced throughout an accounting year within an economy. Next is consumption expenditure, the expenditure by household, individuals, etc. on the final goods and services. Government expenditure, the expenditure by the government on final goods and services is known as the government expenditure. And investment expenditure, the expenditure on the purchase of the goods that would be used for further production. It includes fixed investment on plants and inventory investments on stocks. Next is net export, the difference between exports and import is known as the net exports. Formula is GDP is equal to C plus I plus G plus X minus M. Here C is the consumer spending on different goods and services. I is the investment made by the businessmen and on businesses and on capital goods. G is the government spending on goods and services provided to the public. X is the export and M is the imports. Next type is income method. Next method is income method. So the income method, it is the real estate estimating methodology that divides the capitalization tariff or price by the net operating income of the rental payments, and the calculation is used by investors to evaluate assets depending on the profitability, how much they have got profit. Okay. Classification of factor incomes. Compensation of employee, it comprises salary and wages and in return for the services and talents you give in the production of goods and services. Wages and salaries, payments in kind, pensions, employers contribution, these are the classifications. Here this income method and this expenditure method and this product value or product method or value added method, these types, any one they may ask for 2 or 3 marks, and all they may ask only explain, they may ask for 3 marks also. There are chances out there, only explain they can ask. This also, this little bit they may not ask. Next is operating surplus. It includes operating surplus, it includes three types. That is rent, it is the amount of money paid for the use of land when and machinery is rent paid for the use of machineries and other equipments is not included in this calculation of rent. Interest, it is the cost one pays for borrowing money. This now covers the interest paid when the business obtains a loan for an investment. Profit, it includes dividends, profit tax, undistributed profit. Next is in these three, anything they may ask for 1 marks. Next is mixed income, the income of self-employed professionals, farming units and sole proprietorship is referred to as mixed income. For example, national income is equal to net domestic product at factor cost plus net factor, that is equal to NDPF is equal to rent plus compensation plus interest plus profit plus mixed income. Next, problems of double counting is when computing national income, the problem of double counting arises. The national income estimated becomes muddled when double counting occurs in the calculation of national income. Methods of avoiding this double counting is only the value of finished goods should be counted while final output method, or only the value added to the equals the value of output less intermediate consumption should be counted. Value added method should be used so that we can avoid double counting. Next is private income. It is the estimated income of all factors and transfers to the private sector both within and outside the country. Private income is equal to factor income from the net domestic product accruing to the private sector plus national debit interest plus net factor income from abroad plus current transfer from government plus other net transfer. So this is a big thing, private income. Next is personal income. It is the term personal income, it only refers to the sum of the income money received by all people or households in a certain country. Personal is equal to income is equal to NIN, undistributed profit N. It is the net interest payment made by household in corporate tax plus transfer payments to the household from the government and firms. Next is personal disposal income. It is the disposal income also known as the personal disposal income. Disposal income is also known as personal disposal income. It is the amount of the money available for household consumption, savings and spendings after deducting the income taxes. Personal disposal income is equal to PI into N, personal tax payments, N into non-tax payments. This is the formula. So this was your revision notes for chapter the national income accounting. So okay friends, if this video is helpful to you, please give a like. So this is second part. First part video I already uploaded, so watch both the parts. And if this video is helpful to you, please give a like, and also share my video with your friends so that it will be helpful to your friends also. And also do comment if you need any help in any studies help if you need, so do comment. So okay friends, I will see you in my next video. Then take care, have a nice day, bye my dear friends.